We're jumping straight into OLB Group today. Everyone is watching the price action, but the real story is the pivot to AI-driven commerce and the balance sheet restructuring.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And hey, before we get into the nuts and bolts of what is a really wild ride here, do us a quick favor. If you want to keep getting these breakdowns that cut through the noise and simplify the market for you, hit that subscribe button and smash the like.
It really helps.
It really does. It helps us get this out to more people like you who are trying to navigate these guys.
Well, choppy waters.
And choppy is, honestly putting it mildly, if you've been looking at the ticker for OLB Group recently, you might need a neck brace.
No kidding. Let's just set the scene for why we're even talking about this company right now.
Yeah.
We are recording this in late February 2026. On February 18th, the stock dropped over 28% in a single session.
A huge drop.
That is a massive red candle. If you were holding that, felt like a punch to the gut. It's ugly. There is no way to sugarcoat a 28% drop. But you have to zoom out.
Context.
Context is everything in the microcap world. That drop came right on the heels of just a massive run-up. In the week before, mid-February, this stock saw a return of 261%.
That is just astronomical.
Yeah.
So you have a stock that nearly triples in a week and then gives back a third of it in one day?
Right.
That doesn't feel like investing. That feels like a roller coaster.
It's the definition of volatility. And the question on everyone's mind, and really the core question for us today, is whether that drop on the 18th was a capitulation washout.
The panic selling.
The panic selling, yeah. The thing that scares out the tourists and maybe creates a golden entry point, or if it was a massive warning sign that the fundamentals are just broken.
Right. Is this a falling knife or is it a discount ticket? And to answer that, we have to look past the chart.
You have to.
Charts tell you where the price has been. The balance sheet tells you where it's going. We need to unpack the bull case first, because despite that scary drop, there is a legitimate turnaround story brewing here.
There is, and it starts with understanding their revenue numbers, which, if you just glance at the headlines for 2024, look pretty bad.
Pretty bad is an understatement.
Revenue was down 58% to about $12.8 million.
Ouch. Cutting your revenue in half usually sends investors running for the hills. It looks like the business is just evaporating.
Usually, yes. But in this case, it wasn't an accident, it was a choice. This is what we call a strategic pivot.
Okay.
They intentionally moved away from low-margin business lines. They basically looked at their portfolio and said, these parts aren't really making us money, they're just churning cash, so let's cut them loose.
So it's addition by subtraction. They're shrinking the top line to save the bottom line. It's like firing your worst customers.
Precisely. In fintech, you can have a lot of what I call empty calorie revenue, huge transaction volumes where you keep almost none of the profit.
Looks good on a press release.
Right, but it doesn't help you pay the bills. They cut that fat. And the proof that this strategy is actually working is in the earnings trajectory.
Okay, lay it on me. Where's the proof?
It's in the net loss. They cut their net loss by over 51% year over year.
Wow.
That is a huge slash in their burn rate. They were losing half as much money as they were before they made this pivot.
That's significant. But the number that really jumped out to me in the research, the one that tells me this is an operational turnaround and not just some accounting magic, is the sequential earnings per share.
This is critical. Turnarounds happen quarter by quarter, not year by year. If you look the second quarter of 2025, their EPS was negative 66 cents.
A heavy loss.
A heavy loss. But fast forward just one quarter to Q3 2025, and that loss shrank all the way to negative 13 cents.
Whoa. Going from losing 66 cents to losing only 13 cents in 3 months.
Yep.
That is a massive improvement. That's not just trimming the fat. That's like a whole new diet.
Exactly. And the guidance suggests they are approaching break-in. They are projecting Q4 2025 to be around negative 14 cents.
So they've stabilized.
When you see that kind of rapid stabilization, it tells you that the management team has gotten serious about operational discipline. They aren't just hoping the market turns, they are fixing the engine while the plane is flying.
Okay, so they stopped the bleeding. That's step one. But you can't save your way to growth forever. Eventually, you need a product people actually want to buy.
Right.
And this is where the AI buzzword comes in. Usually, I roll my eyes when a company pivots to AI. But let's talk about iStores.
This is the catalyst. In January 2026, they launched the iStores AI platform. And look, we hear AI thrown around by every company trying to pump their stock, but here's the actual value proposition.
Right.
It automates online store creation and payment processing for small and medium businesses.
So if I'm a local baker or a boutique shop owner and I don't know how to code, iStores uses AI to, build it for me.
Essentially, yes. Think about all the friction involved in setting up an e-commerce site.
It's a huge headache.
It is. You have to pick a template, upload photos, write descriptions, connect a payment gateway. iStores is pitching text to shop. You tell the AI what you sell, and it builds the infrastructure.
It simplifies the entire onboarding process. And the market liked it, right?
The market loved it. The stock popped 8.5% immediately after the launch.
Okay.
That tells us there's product market fit, or at least there's investor appetite for this kind of solution.
I like the analogy of this being a competitive moat.
Yeah.
You have giants like Block or PayPal, but they're massive and sometimes complex.
Mm.
OLB Group is using this AI angle to target the underserved merchants who just want simplicity. They don't want a complex backend. They want a store that just builds itself.
That's the bet. It's about reducing the friction for the merchant. If you can make it easier for them to sell, they stick with you. And stickiness is the name of the game in payments.
Now, we can't talk about the bull case without looking at the bank account.
Okay.
And this was the most surprising fact I found in the notes.
I know which one you mean.
0 external debt.
It is incredibly rare. For a microcap fintech company, a sector that usually runs on leverage and loans, to have 0 external debt is like finding a unicorn.
Why is that so important right now, though?
Because debt is expensive.
Yeah.
If you are a small company with variable rate debt, your interest payments are eating you alive. It just kills your cash flow.
Right.
OLB Group doesn't have that problem. They have no creditors breathing down their necks. There's no refinancing risk. If the credit markets freeze up tomorrow, OLB doesn't care.
That is a fortress balance sheet. And it seems like management knows it because they are buying back their own stock.
That's a massive signal. The board authorized a 1 million share buyback, and they have already repurchased over 100,000 shares.
I love seeing that. It's the ultimate vote of confidence. It's insiders saying, we know what we have and we think the market is pricing us wrong, so we're going to buy it ourselves.
It puts a floor under the price, psychologically at least. And there's one more hidden asset we should probably mention, Dement.
Right. The crypto side hustle?
Well, it's becoming more than a side hustle. They refiled the S-1 in January 2026 to spin off Dement, which is their digital asset and crypto division.
So they are separating the volatile crypto stuff from the steady payment processing business.
Exactly. It unlocks value. Right now, OLB suffers from what we call a conglomerate discount.
Okay.
Traditional investors hate the crypto risk, and crypto investors think the payment business is boring. By separating them, you allow each business to trade at its true value.
And for the shareholder, it's a bonus.
It's a lottery ticket. If the spinoff happens, OLB shareholders could end up with shares in a separate pure-play crypto company. If the crypto market rallies in 2026, that could be worth a lot.
Okay, so that's the sunny side of the street.
Yeah.
You have a turnaround, you have AI growth, a clean balance sheet, and a spinoff. It sounds great, but we have to be real. There is a reason this stock is trading where it is, and there is a reason it dropped 28% in a day. Let's flip the coin and look at the bear case.
We have to, and we have to go right back to that revenue number. I know we called it a strategic pivot, but from a skeptic's point of view, dropping from $30 million to $12 million is painful.
It's a huge hole to dig out of.
It is. When you shrink that much, you have less room for error. You have smaller cash flows coming in the door every day.
Right.
If this new strategy with iStores doesn't work, and it doesn't work fast, they don't have the old revenue streams to fall back on. They burn the boats.
And to fuel this new strategy, they needed cash. Let's talk about the dilution, because this is what really spooked the market on February 18th.
This is the lowdown on the drop. They did a private placement to raise $3 million. Now, raising cash is good for survival, it keeps the lights on, but it's bad for existing shareholders if the terms aren't great.
And these weren't.
They sold shares at 60 cents.
60 cents. And keep in mind, the stock had been trading higher than that, so they sold equity at a discount.
Right. But the real kicker wasn't just the price, it was the warrants. They attached warrants at 78 cents.
Okay, for the listener who might not be a financial pro, let's explain dilution risk and why these warrants specifically are such a wet blanket on the stock price.
Think of it like this. You own a slice of a pizza. Then the company decides to cut pizza into way more slices to sell them to someone else.
Your piece just got smaller.
Your percentage of the pizza just got smaller. That's dilution. Currently, there are about 13.3 million shares outstanding. But if those warrants get exercised, it just floods the market with even more shares.
And that creates what traders call an overhang, right?
Exactly. It caps the upside. Imagine the stock starts to rally, it goes up, it hits 78 cents. Suddenly, all those investors holding warrants say, great, I can buy at 78 cents and sell immediately for a profit.
Creating a massive wall of sellers.
A massive wall of sellers. So every time the stock tries to break out, this new supply hits the market and knocks it back down. It's like a ceiling made of sell orders.
So until those warrants are cleared out, it's very hard for the stock to sustain a rally above that level.
Very hard. And then there is the execution risk. We talked about how cool the iStores platform is, but is it actually scaling?
That is the $3 million question.
Literally. They raised $3 million. Based on their burn rate, that gives them a runway of maybe 6 to 9 months.
That is not a lot of time. That's
Yeah.
basically 2 or 3 quarters to prove this works.
It's a sprint. If their customer acquisition costs, what they have to pay to get a new user, are too high, they could burn through that cash very, very quickly.
So iStores is unproven at scale.
We saw it pop on the news, but we haven't seen the sustained revenue yet. We are betting on the press release, not the bank statement.
And it feels like we are guessing a bit because of the information vacuum.
That's a huge risk factor for retail investors. There are no formal analyst ratings. No big banks, no JP Morgan, no Goldman Sachs are publishing price targets or research on OLB Group right now.
So you're flying blind. Institutional investors might have better data or access to management, but the average person is relying on press releases and SEC filings.
Correct. And when you combine that lack of information with a beta of 2.06, you get these wild swings.
Let's break down beta quickly. 2.06.
Beta measures volatility relative to the market. A beta of 1 means you move with the market. A beta of 2.06 means this stock is roughly twice as volatile as the S&P 500.
It's high octane.
Very. If the market sneezes, OLB catches a cold. If the market rallies, OLB goes to the moon.
And that gap down on February 18th shows just how quickly sentiment can turn when dilution news hits the wire. It just amplifies the panic.
Exactly. So we have a clear battle here. The turnaround narrative versus the dilution reality. If you are watching this stock or if you are already in it, you need to know what triggers to look for. You can't just hope.
Right. So let's give everyone a roadmap. What are the milestones we need to watch in the next few months?
Okay, there are 3 critical triggers. The first one is coming up fast. The Q4 earnings report expected around April 14th, 2026.
April 14th. Mark your calendars.
Yeah.
What are we looking for? Just the EPS.
The consensus is a loss of 14 cents per share. If they beat that, great. But honestly, I'm looking past the earnings number.
Okay.
I want to see the rate of iStores adoption. Are they signing up merchants? That metric matters more than the bottom line right now because it proves the growth story. If nobody is signing up for iStores, the bull case it falls apart.
Okay, so trigger 1 is the adoption rate in April. What's trigger 2?
The warrant window in Q2 2026, remember those warrants at 78 cents?
Mm-hmm.
They become exercisable in 6 months, so around summertime. Yeah. If the stock price is above 78 cents, or especially above 92 cents, where some repricing happened, we could see a capital influx.
Okay, so that means cash for the company.
If warrant holders exercise, the company gets cash. That's good. It extends their runway. But it also means more shares hitting the market.
You overhang again.
Exactly. It acts as a call option on the company's survival. If they are doing well, the warrants get exercised, they get cash, but the stock might stall a bit due to the extra shares. You have to be prepared for that churn.
And finally, trigger 3 is the DMINT spinoff.
Watch for the completion of this split, probably in Q2 or Q3 of 2026.
Lottery ticket.
It's the lottery ticket. If the crypto market rallies in 2026 and they successfully spin this off, shareholders of OLB could end up with shares in a separate pure play crypto company.
A potential bonus.
A potential bonus that isn't fully priced in right now, but again, it's highly correlated to Bitcoin. If crypto crashes, the spinoff might get shelved.
So let's bring this all together. Let's synthesize this for the listener who is trying to decide what to do. This feels like a classic high-risk, high-reward setup.
It is the definition of asymmetric risk. On one side, you have a company trading like a distressed asset. It's beaten down. People are scared of the dilution. The chart looks broken.
Yeah.
But on the other side, you have a zero debt balance sheet. You have a scaling AI product. And this is key. You have over $1.3 billion in transaction volume.
That transaction volume is no joke. $1.3 billion moving through their pipes. That implies they are a real plumbing system for the economy, not just some concept stock.
It shows they have stickiness. They're a real business. But the market is currently fixated on the cash burn and the recent share printing. It's a tug of war between the financial reality of today and the operational promise of tomorrow.
It really is. And here is where I want to leave you with a final thought, something a bit speculative to chew on. We talked about that volume and the zero debt. Think about the landscape of fintech right now. You have giants like Block, formerly Square, and Stripe fighting for market share.
And they are always hungry for merchant acquisition.
Exactly. Acquiring customers one by one is expensive. You have to run ads, do sales calls. Buying a network of merchants that is already processing over $1 billion, that might be cheaper.
And with no debt to pay off.
With no debt to pay off, is OLB Group actually sitting there as a prime takeover target for a larger player?
It's a valid question. The valuation is low enough that a buyout would be pocket change for a company like Block.
Right.
It's not in the sources, strictly speaking, but logically, when you see a clean balance sheet and high volume trading at a microcap valuation, M&A is always a possibility.
It's certainly something to keep in the back of your mind as you watch that ticker. Verify those dates, keep an eye on April 14th, and don't let the daily volatility shake you out if you believe in the long-term pivot.
And as always, do your own due diligence. We are here to simplify the story and give you the map, but it's your money.
Couldn't have said it better. Thanks for tuning in to the Easy Money Show. We'll catch you on the next one.